Today is the 28th of March 2022. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500 and Nasdaq and gold and Bitcoin, so there is a lot to talk about. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. Let's kick things off with the S&P 500, and this is the analysis that we've been looking at over several weeks, months now, which places the 18-month cycle trough as having occurred at the beginning of October. And as discussed in recent market update videos, we were looking at the market coming down and forming a 20-week cycle trough according to this analysis. There is, of course, an alternate, which we'll take a quick look at, which is that the 18-month cycle trough was the trough that formed at the end of February, I think it was, is that low point. So let's quickly take a look at that analysis. Here it is, and as you can see, the difference here is that the 18-month cycle trough is the trough that formed there at the end of February. So I've been discussing the details of these two analyses over many weeks, and so there isn't very much to add here, except for the fact that we now do have in the analysis the fact that the trough has been confirmed, whether it is an 18-month cycle trough or whether it is a 20-week cycle trough. Now, what are the possibilities that it is 18-month? Well, if we measure the distance from the March 2020 trough, then you will see that is a little over 700 days. 23.1 months. The average length of an 18-month cycle is 546 days. And so 703 days is really long for an 18-month cycle. Many analysts would argue that it is much too long, and possibly it is an impossible cycle length, and so therefore it cannot be the 18-month cycle trough that formed there, making it more likely that the 18-month cycle trough actually formed over here at the beginning of October at a much more reasonable length of 559 days, which takes us back to the other analysis. The way that I like to do this is that I keep an eye on both analyses. I cannot positively and certainly state whether that was the 20-week cycle trough that formed at the end of February or whether it was the 18-month cycle trough. I believe it's not really possible to say with complete certainty which trough it was. So it's a really good idea to keep an eye on both analyses, which I hope is something that you are doing. Let's go back to the other analysis, which in my opinion is probably actually the better analysis at the moment. Let's zoom in just a little bit, and you can see that with this analysis we have influenced the analysis to position the 18-month cycle trough there at the beginning of October. That's what that pin symbol means, which means that this would be the 18-month cycle trough, and what we have seen elapse since then is a 20-week cycle. I've discussed all of this in previous market updates, so I don't really need to dwell on it, but if we zoom in and take a closer look at how this 20-week cycle trough actually formed in the market, we can see that there is the low point in price and there is the marker for the 20-week cycle trough. And if I display the 20-day FLD, you can see that price did finally cross up above that FLD. I think that was on the 16th of March, and you can see that price crossed up very clearly above the 20-day FLD. At that point, of course, we can generate a target measuring from the low point to the price cross and generating a target to the upside, which was then reached. Now, the interesting thing about the S&P 500 is that we have this lower price over here in the last week of February. So that is where we have positioned the 20-week cycle trough, of course, meaning that this low point over here in the middle of March must be the 20-day cycle trough. If I zoom in even closer and take a better look at that, and we'll do the same thing with the Nasdaq in a moment, which presents a slightly different picture, but you can see that Following the 20-week cycle trough that formed over there, price came up to the 20-day FLD and failed to get above it. That is what we discussed in our previous market update video. Then it dropped down below the 20-day FLD and only finally crossed up over here. That is not what we usually expect for the interaction between price and the 20-day FLD following the formation of a 20-week cycle trough. The first interaction that we should usually encounter is labeled an A category interaction, and that is a clear price cross above the FLD over here, which raises the question as to whether the trough should be actually positioned over here at the end of February, where we had this strong move down. I think that was the morning that the war in the Ukraine started, and so there was some volatility because of that. And that volatility might have pushed price lower than it would have otherwise gone, indicating that perhaps a better position for the 20-week cycle trough might be over here in the first week of March, making this indeed an A category interaction. That would, of course, push the 20-day cycle a little further out. And so I would not be surprised to see price finding support at the level of the 20-day FLD, even though we are, according to this analysis, expecting a 40-day cycle trough. Nevertheless, the trough that we have been expecting has now been confirmed in the market, and as discussed in previous market updates, the first thing that we look for in terms of confirming a trough is price crossing clearly above an FLD. Of course, price crossing above the 20-day FLD only confirms the magnitude of the trough as being of 20-day magnitude, but because of the principle of harmonicity and synchronicity, we know that that must be a trough of at least 20-week magnitude, possibly even 18-month magnitude. Now, in favor of the possibility that this was indeed an 18-month cycle trough is the problem or the anomaly that I've pointed out in previous market update videos, which is that this first 20-week cycle following the 18-month cycle trough in this analysis is in fact a fairly bearish cycle. It is in fact a mixed cycle shape, but the fact that it ended the cycle at a lower price than the price at which it started is of course a bearish indication. And when we look at the Nasdaq, I will remind us very quickly of one of the possible reasons why we might be encountering bearish cycles at this time. But that is an anomaly in this analysis. And if we zoom in and take a look at the composite model line, which takes all of the information from the cycle analysis on the chart, recomposes it and creates this dashed orange line, we can see that the anomaly is very clearly represented in the composite model line, which indicated that the 20-week cycle trough was expected, according to the information on this chart, to have formed at a higher level. This is what we would have expected, really, for that 20-week cycle, was a more bullish cycle, and price has diverged, as you can see very clearly on this chart, and has provided us with a lower trough than the trough at which that cycle started. If we take a look at the composite model line on the other analysis with the 18-month cycle trough over here at the end of February, then you can see there isn't that anomaly present in comparing the composite model line and the price action. The composite model line does match the price action a little bit better here, indicating that this might be a better analysis, but that is by no means a definitive proof of this being the better analysis. Certainly, this composite model line tells us to expect a good deal of bullishness, and that is because of the fact that we have a very big magnitude trough over here in March of 2020 and an 18-month cycle trough over here in February, and that is, of course, a very bullish message. Because we have the two possible analyses, I'm going to be keeping a close eye on this market as it bounces out of this trough for confirmation that we are in a new bull out of an 18-month cycle trough or not. Now let's take a look at the Nasdaq, and the situation here is very similar in terms of the magnitude of the recent trough. It is either an 18-month cycle trough or indeed a 20-week cycle trough, which we will take a look at in a moment. Here is the chart that explains why we might have seen this recent bearish cycle shape developing, because of the fact that in the Nasdaq it seems likely that the bigger cycle trough, the 54-month cycle trough, formed in December of 2018 as opposed to the March 2020 trough. There isn't very much to add here except for showing the composite model line, which according to this analysis in the Nasdaq also promises some very bullish activity because of the fact that the 18-month cycle trough potentially formed over here in the beginning of March. But here is the other possibility in the Nasdaq, which positions the 18-month cycle trough over here at the beginning of October. This is an analysis that I have presented in previous market update videos, so there isn't much to say about it, except the fact that, of course, now we do have a 20-week cycle trough over here. And here we can see that the 54-month cycle is, in fact, influencing some bearishness in this market, according to this analysis, because of the fact that the 54-month cycle trough occurred in December of 2018. And so this analysis certainly presents a reason for the fact that we have had a bearish cycle elapse since October of last year. If we display the composite model line for this analysis, you can see that in fact this recent 20-week cycle trough occurred much lower in price than it was expected by the information contained in the cycle analysis and recomposed into the composite model line. And so although we do have a reason or a possible reason for that recent bearishness, it is not actually present, or I should say that evidence of that bearishness is not really present in the cycles at the moment, and so the composite model line is indicating some bullishness, of course, as price breaks out of the recent trough at the beginning of March, but it is warning of a more bearish price move coming down into this 54-month cycle trough in about the middle of 2023. And if we zoom in on that price action, you can see the composite model line is indicating a price rise up until about early or mid-May, and then of course a price decline into this big 54-month cycle trough expected in the middle of 2023. So again, we have the two possibilities. The first possibility, that the 18-month cycle trough formed recently at the beginning of March, and here is the lowest price in the Nasdaq, which as you can see occurred in about the middle of March. If that was an 18-month cycle trough that formed, then we are looking at a sustained bullish move. I am going to be watching very closely as price approaches this peak round about here in about the middle of May, or perhaps a little bit earlier in the first week of May, and then see what price is doing to indicate whether we can get any greater clarity on the magnitude of the trough that formed at the beginning of March. When we took a look at the S&P 500, I discussed this interaction between price and the FLD. Here it is very clearly an A category interaction, and price has crossed up above the FLD, and it has achieved its target, which it did at some point last week. And of course, the next thing that we would expect here is for price to come down and find support at the level of the 20-day FLD in a typical B category interaction. Now let's take a look at gold, and of course we have been expecting an 18-month cycle peak to form in gold, and there is that peak. The fact that an 18-month cycle peak formed in gold does also increase the possibility that the recent trough in stock markets has been a trough of 18-month magnitude, despite the fact that that implies a very long 18-month cycle. I discussed possibilities of the pandemic perhaps distorting the cycle shapes. I know that's a fairly contentious subject, but certainly the fact that we have clearly witnessed an 18-month cycle peak in gold would tend to increase the possibility that an 18-month cycle trough also formed in stock markets. We'll zoom in a moment to take a look at how that 18-month cycle peak has been confirmed, because I discussed in the previous market update the various steps that we need to take in order to confirm that a peak or a trough has formed, and it's been very clear in gold. But the composite model line in gold is very informative at the moment. You can see that here I am combining information from both the peak analysis and the trough analysis. The peak analysis, as I've mentioned in many previous market updates about gold, is the more important one in my opinion. I believe that gold is influenced by cycles that are synchronized at their peaks, which means that it cannot be influenced by cycles that are synchronized at their troughs. And that is why I tend to focus on the peak analysis in gold. But the trough analysis provides us with some useful information, and when combining the results of the two analyses, we end up with this really very good and very accurate composite model line. In the past, it shows us the combination of the two analyses, taking the cycle information from the analysis, recombining it, and showing us how price would have moved if the only thing influencing price in the past had been the cycle information as found in this analysis. The important thing, of course, with the composite model line is that it is indicating that the implications of this analysis are that the price of gold is going to move down from this 18-month cycle peak over the next few months. I mentioned in the previous market update video about gold that when price drops away from a possible peak, that doesn't, of course, confirm that the peak has formed. There are several things that we expect to occur, and the first of those is that price should drop below an FLD of our choice. Now, of course, there is an FLD for each and every cycle, so which FLD would you use? And the FLD that you choose to confirm that a particular trough has formed would depend upon your confidence in the analysis. I have been confident in this analysis for some time in terms of expecting this 18-month cycle peak. And so when price crosses down below the 20-day FLD, which is simply a very reliable FLD in my experience, that is the first piece of evidence that a peak has formed. That's the first piece of evidence. The next piece of evidence, as mentioned in the previous market update video, is that I expect price to then find resistance at the level of the FLD, which is effectively what it did on Thursday of last week. I've now drawn over that, so let me actually just rub that out. There's our first piece of evidence. Second piece of evidence is over here. As price came up to the FLD, and it found resistance, not perfect resistance, as you can see, because on Friday it was a little bit above the FLD. But in pre-market trading, I'm recording this video before the markets open in the United States, price has dropped down to, again, bring it below the level of the FLD. FLDs sometimes provide perfect support and resistance, but more often they provide approximate support and resistance. And so this is the next piece of evidence in the confirmation of this 18-month cycle peak forming in gold. Now let's take a quick look at Bitcoin. And in the previous market update about Bitcoin, I spoke about the fact that Bitcoin was falling out of a very big peak that formed in November of last year. That is probably a 54-month cycle peak that formed then. It might only be an 18-month cycle peak, but it is nevertheless a fairly important and prominent peak. I spoke in previous market updates about the fact that Bitcoin had been beating with a fairly regular rhythm in terms of its troughs, indicating that it seemed to be influenced by cycles synchronized at their troughs. But how recently, particularly following the big peak that formed in November of last year, the peak analysis seemed to be the more accurate analysis, which might have indicated that Bitcoin had shifted from being influenced by cycles synchronized at their troughs to being influenced by cycles synchronized at their peaks. It's something I've discussed in many previous market update videos. It's a point of great fascination. I don't know why instruments sometimes shift from being influenced by cycles synchronized at their troughs to being influenced by cycles synchronized at their peaks. But it is something that does seem to happen, particularly when it comes to currencies. And so it's a very fascinating subject, I believe, to discuss. I'm not going to discuss it now, but certainly the peak analysis does seem to be more important in my opinion. And so at the moment I am watching the peak analysis more closely. What seems to have happened is that the 80-day cycle probably formed a peak over here in February, and price is now moving up to this 20-week cycle peak over here. Our nests of highs have become a little bit staggered, and so we need to watch the price fairly closely to make sure that we are ready for that peak to form when it does. But let's take a look at the composite model line to see what the implications of this analysis are. Here is a composite model line that combines both the peak and the trough analysis, and you can see it is not a perfect match for price, but you can see that it warns us that a peak is expected fairly soon, perhaps towards the second week of April, or perhaps even the first week of April, and then we should see a price move down. That is because of this trough over here. And then we'll see price come up again into this 40-week cycle peak, which is expected in about the middle of July. But now this is a composite model line that combines both of these analyses, and in the previous market update about Bitcoin, I presented a composite model line influenced only by peaks, which is, in my opinion, a better composite model line. We can take a look at the one that only shows the troughs. Let's deselect the peaks. There we go. That's a composite model line constructed out of the analysis only considering the troughs, the synchronized troughs, and ignoring the peak analysis. You can see it is not really a very good match, although the structure of the composite model line compared to the structure of the price movement is a fairly good match. But the far better composite model line, in my opinion, is that constructed by assuming that these cycles are influenced at their peaks. There is that composite model line. I think you will agree it is a much better composite model line. But in fact, this again tells us to expect a peak over here. That is where that nest of highs is, and that is in early April. Then that will be followed by a move down, not of course into this trough, because this composite model line is ignoring the trough analysis, but of course we expect price to move down to a trough between two peaks, and so the next peak to look out for is of course this 40-week cycle peak over here in about late July, or perhaps even in early August. And if we zoom in and hide the trough analysis at the moment and only consider the peak analysis, we can see that this is what is expected, the peak forming over here in early April, a move down into about the middle of May, and then another move up into the end of July. Now you'll notice that price has recently accelerated up faster than the composite model line has expected. That's the kind of thing that often happens in Bitcoin in my experience. Bitcoin is a fairly volatile instrument, and when it is moving in the directions influenced by the cycles, it will tend to pick up a little bit of speed and move with greater volatility than the cycle information on its own would seem to indicate. But certainly we are currently enjoying a bullish move in Bitcoin, and we're going to be looking out for, first of all, this peak in April, and then of course this peak in late July. I do hope that you found this market update useful and interesting. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.